Now, yesterday was a pretty interesting day as the market sparked a nice sell-off here. If you've missed what's taking place, you've probably heard of DeepSeek because it's all over the news. The Chinese startup DeepSeek wiped out $1 trillion off the US stock market. With AI that costs a fraction of ChatGPT, is China a true competitor now when it comes down to AI? We've been in a technology war for decades, and it's definitely heating up with the conversation of AI. With this global sell-off that DeepSeek created, we watched companies like Nvidia and Oracle lose nearly 20% in one day, wiping out hundreds of billions of dollars of valuation. Now, along with a lot of your tech companies, we watched energy companies as well sell off. Companies like Constellation Energy down over 20% in one single day. Now, to be fair, a lot of these companies had multiple hundreds of percents run up over the last couple years, so for them to dip 20-25% is not anything outrageous here. The problem is obviously the people that have gotten into these names a little bit later that may be now down substantially in these positions. And I actually think this has created some interesting opportunities, which we're going to go over a stock that I recently bought here. Now, in the midst of this sell-off and the NASDAQ losing right around 3%, the odd thing was more stocks were actually up yesterday than down. The problem is how technology is such an overweight in all indexes. And this is something I brought up numerous times. Multiple expansion in a lot of these tech names have really left a lot of interesting names to be very cheap. But there is a small cap tech company that I did scoop up yesterday on the sell-off, and we're going to go over that right now. In the midst of yesterday's sell-off, I did scoop up a company called Penguin Solutions, ticker symbol PENG, P-E-N-G. I want you guys to pay attention to the volatility in this name. We've seen it hit lows of 14.87 and highs of 29.81, so very, very volatile name. And with yesterday's sell-off, I had the opportunity to scoop some shares up around $18.40. Now, this company recently reported earnings and it shot up to over $21 a share. As you guys can see here, $21.84, beat on top and bottom lines by a mile. But the guidance left it kind of flat. And then with yesterday's sell-off, I thought this was a tremendous buying opportunity. And we're going to go over why that is. Now, some of Penguin's partners you may well know: Dell, Nvidia, Intel. This is a company that's trading for under a $1 billion market cap, and it does revenue between 1.2 to call it 1.5 billion over the last few years. The revenue has been up and down, but recently blew the doors off of earnings, and I think this is a tremendous buying opportunity. Now, of course, this is not financial advice. This is just my personal journey here, and I did add into this position, and I would be looking to add more if it got back down to $15 a share. Now, analysts have price targets as low as $21, as high as $30. Currently, the stock was sitting around $18.40 when I scooped up some shares, now trading around $18.80. And the sentiment around the stock is very interesting here. Barclays recently initiated a buy around January 9th for $23 a share. Needham initiated a buy at $27 a share, January 9th as well. This is obviously around their earnings beat. Loop Capital initiated a strong buy with $30 a share. So we can see that the sentiment around the stock is actually pretty positive. So what recently took place with the company? Well, the first thing I want to point out is valuation here. This is a company that, as I stated, does 1.2 to about 1.5 billion in revenue, is trading for under a $1 billion market cap, and from an EPS standpoint is looking to do between $1.75 to call it $2 a share over the next couple years. So there is some growth here in share appreciation, and it's trading at a reasonable valuation from an adjusted basis at 10 times, 11 times forward earnings, with the possibility to grow around 15 to 20%. Now, as I stated, sales have been up and down, but I think we're going to see some more consistency here because they deal with advanced computing, integrated memory, and optimized LED, which is all going to revolve around higher demands needed with all this AI and quantum computing. So they are in the right place at the right time. They are growing pretty rapidly here in a specific segment, and this is why I bought the stock. Obviously, we see 24% growth versus the year ago quarter. Gross margins down 150 basis points, which we don't like to see. Now, GAAP diluted EPS was 10 cents versus last year's negative 23 cents. So we're starting to see fundamentals actually tick into this company. We're seeing tremendous growth, but specifically where we get interested in this stock was their specific performance of their 49% year over year growth in advanced computing. This is a huge growth rate, and it is their largest revenue source. So they're growing their largest revenue source by extreme amounts here. And I tend to think that this is a trend that's going to go into their favor. And that's why I took a position in the stock on the recent sell-off here. I think valuation is appropriate. I think the company's worth a lot more if they can continue these growth rates. And we're starting to see fundamentals tick in here from a gap perspective. Now, what ended up making the stock trade sideways was the fact that they grew over 24%, but they're guiding for about 15%, give or take 5%, which is nothing really impressive after you display 24% growth rates with 49% coming from computing. So I decided to run my analysis on this company here pretty conservatively, and let me explain how this analysis works because I did have some questions in the comments. So as you guys can see, this is a company that is projected to grow, call it 15 to 20%. My revenue growth rates, I'm using very, very conservative revenue growth rates here. This is a company that hasn't really proven to show consistent growth. It's been ups and downs pretty drastic here. So I'm using 9, 5, and 3% growth rates, which I think are very, very reasonable for this company. My required rate of return is 11%. So what is this required rate of return doing? This required rate of return that I'm putting into the equation is going to discount EBITDA and it's going to discount my free cash flow. So the two numbers you guys are going to see is projecting out an 11% required rate of return or a safety net that I'm essentially building into my evaluation. This is a low float, but they are increasing shares probably mainly for stock-based compensation. So what my analysis does is it takes the enterprise value of what I'm projecting the company to do by 2033, and we put a multiple on that value, which then gives us a stock price. Along with that, I'm discounting future cash flows at that rate as well. So we get two price targets here. We get a $15.38 free cash flow price target, and we get a $23 price target when it comes to a multiple of EBITDA, with a future value sitting a little over $40 a share, which I think is extremely reasonable considering the stock was trading around $29 a share not that long ago. Now, if they maintain these growth rates, I do think that this was a very reasonable buy. I'm giving a price target between, call it $18 and $19 a share, so scooping some up around $18.40 made some sense for me personally, and I would be really interested to buy closer to that $15 mark if the opportunity presents itself. So with the stock, when I bought the stock, it was trading for under a $1 billion market cap. We can see that the short interest is actually fairly high in this name, but the one thing I do like is the fundamentals are finally coming through, which we should see the short interest dry up. The stock's down nearly 12% on the year, but the fundamentals are actually getting stronger. So I think I'm buying it at a very reasonable price here. As the stock is down nearly 12% on the year, we bought it at a reasonable valuation. Analyst expectations seem pretty strong on the company, and it's recently had some upgrades with some positive news and AI partnerships. As I stated, from a non-GAAP basis or an adjusted basis, it's very cheap. From a GAAP basis, obviously, this is still a growing company. It's a small cap company. And those fundamentals are going to get stronger and stronger and stronger, closing the gap between its sector median. Where it becomes interesting is how cheap it's trading from a multiple to EBITDA, from price to sales, from price to book. So on multiple metrics, this looked like a reasonable buying opportunity. I still think it's a higher risk, higher reward type of opportunity, but I also think the company is positioned pretty well. Let me know down below if there are any companies you bought on this recent dip. And as always, guys, appreciate your time, and we will see you all in the next one.